Transferring wealth successfully starts with asking yourself questions that will give your family a better life now and for generations to come. In this podcast, financial experts John and Michael Parise from Copper Beech Financial Group guide you through eye-opening questions to help you discover the truth about your wealth. Now, on to the show.
Hello and welcome to The Truth About Wealth with John and Michael Parise of Copper Beech Financial Group. I'm Wendy McConnell. Hey there, fellas. How are you?
Hey, Wendy. How are you?
Hey, Wendy.
I'm good. Whenever I see you guys, I just want to call you fellas. Hey, fellas.
You can call us anything you want.
That's
We're
fine.
Good. We're flexible.
Don't say anything, John.
Hey, you.
It could be worse. I mean, you could, yeah, worse nicknames.
So I do see we have a guest today. Do you want to tell us about him?
Sure. We have with us Mitch Kerr, Senior Portfolio Manager with Ategenos Capital. How you doing, Mitch?
I'm doing well, guys. Great to be here. Thanks again for inviting me to join.
Hey, Mitch. Good to see you again.
Yeah, we're excited to have you here. We were just speaking the other day, and you have a variety of things that you can talk about, but we're recording. We're recording this, I guess, a little over a week after the election, and so there's obviously a lot of things going on these days. But we thought that given your background, which I'll ask you to kind of introduce yourself and the company in a second, but having given your backgrounds in the energy sector, we thought that having a discussion on what the energy markets might look like going forward. I know we talked a little bit the other day about your experience and research on sort of nuclear technology and how that might be shifting. So I think we can go in a lot of different directions, but love to get your thoughts on that if we can.
Absolutely. So Michael and John, once again, appreciate the opportunity to come here and join you for this. To give a bit of my background, so I work for Ategenos Capital. We're a boutique money manager specializing in working with high net worth individuals and family offices, providing asset allocation advice and asset management. Myself, background-wise, I've been in the industry just a little over 23 years. Spent some time in investment banking with Morgan Stanley in the energy division and M&A. Then spent 10 years as an individual equity analyst at a place called Gardner Lewis Asset Management, which was a small cap and large cap stock picker space. Then moved on to Wells Fargo, and then finally made my way from Brinker Capital to Ategenos, where I'm a senior portfolio manager working with high net worth individuals. And I also sit and have the privilege to sit on our investment committee, where I help shape our investment policy for high net worth individuals for whatever their long-term goals are.
Fabulous.
Yeah, it's awesome. Yeah, it's a wide variety of roles that you've had over the years, and it's great background you have. So, Mitch, I mean, to start it off in a kind of an open-ended type of question, what are the things that our listeners should be considering going forward here in light of the election and the energy markets going forward? I know there's a lot of changes that might be happening. A lot of both, I guess, sort of fiscally at the government level, and then just things that are happening outside of the government that might influence where the energy markets go. So maybe you can give us a little bit of an update on where things stand today.
Yeah, absolutely. I think when you read most headlines as you're looking what's out there, and there's the word out there, drill, baby, drill. And it's the idea that deregulation by the new Trump administration is going to allow so much new oil production to happen, it brings the U.S. back to oil independence. Well, I'll throw a little cold water on that from a reality standpoint of what can happen in the very near term. We're already at an all-time high of about 13.7 million barrels of production currently. And if you look at that, it's about 300,000 more than we were producing last year. The issue you're going to have right now is oil is currently in that $60 to $70 range when you look at WTI crude. And, unlike several other countries, all these oil companies are still very much for-profit entities. So with oil and I say oil only in the $60 to $70 ranges, I've been in the industry long enough to remember when oil was $120 a barrel and things like Hubbard's Peak and all those craziness of peak oil prices really happened. There's not a huge incentive for oil companies to drill an extreme amount of new wells and new production in the very near term. Now, it doesn't mean that the energy industry is not going to change and there's not opportunity there, but I think the immediate impact of oh, there's all these wells that we just need to turn the spigot on and we're going to flood the market with oil is a little bit overstated, at least in the near term. Where I think there's initial and immediate opportunity is really in the natural gas space. And it really doesn't get talked about that much, but I think it's worth, spending a couple minutes there. Natural gas in regards to pricing at the Henry Hub has been pretty close to $2, per unit for about the past 24 months. Now, while that's not very exciting, it does tend to power a lot of the fossil fuel powered plants around the country. But what's really interesting is the current administration that's in place had put a freeze on liquefied natural gas exports. Now, liquefied natural gas, for those listening who don't know what it is you're taking that natural gas, you're condensing it into a liquid and making it a way you can ship it and export it to other countries. Now, where that's likely going to come into play, and it's pretty interesting to discuss, is our relationship with Europe. Europe right now is incredibly dependent on Russia for its natural gas supply. That's why during the Ukrainian war, you heard about all the issues that was happening in regards to Europe going through a cold winter and being susceptible to shortages in natural gas. Well, there's already talk of the new entering Trump administration that the restrictions on liquefied natural gas permit exports will be repealed almost immediately. So there will be a large increase in liquefied natural gas exports from the U.S. Now, why is that important? And this is where you can go down a million different rabbit holes.
I was going to say. Yeah.
And why I love what I do. There's also the talk of tariffs. It's the scary word that everyone's talking about that's going to make everything more expensive if you read what every article that's out there that kind of poo-poos them to a certain extent. Well, liquefied natural gas and our relationship with Europe could be a solving point for a way for Europe to avoid having tariffs put on their goods. Meaning, if we're able to negotiate liquefied natural gas contracts where we're shipping and exporting liquefied natural gas to Europe on a pretty immediate basis, the administration may look to lessen the impact or eliminate tariffs on Europe-made goods. So it's a bargaining chip that the new administration will likely play with in order to, one, increase exports of liquefied natural gas and, really have a significant increase to energy production from that standpoint and profitability, but also ally ourselves with the European Union in a way that benefits them, but also sets us up for some energy security and things for the long term. So although the drill baby drill aspect of things from oil sounds good on paper, it's not probably going to happen in the very near term. But I think in the natural gas market, there's a lot of things that could change in the very near term that could drive some pretty significant, geopolitical negotiations that I think will be very, very interesting for energy investors. So what does that mean? It means the natural gas guys are going to try to produce more natural gas because there's actually a place for it to go. So that's the first statement. I'll stop myself there because I'll talk about this stuff all day and probably bore all your listeners. So I think it's that's the first piece of the puzzle that I think is really interesting that a lot of people tend to overlook.
Hey, Mitch, real quick. I know you mentioned drill, baby, drill, and I think that's interesting. Trump's incredible when he kind of talks about that. But fracking has played a key role in just getting the oil, though maybe you're not drilling as many wells, but the fracking allows you to get that oil out of the ground at different levels. Can you talk a little bit about what fracking actually means? And number one, is it dangerous? You always read articles, it's dangerous, it's going to collapse the whatever. Just talk about that a little bit.
Yep. So the crazy thing is fracking really isn't that new. When I was an energy analyst, and this was 15 years ago, the first idea of fracking and increasing the output of oil and natural gas from wells using fracking was just coming into fruition, and every company out there was bringing it out. It's really the idea of putting high pressure, whether that be liquid or gas, into rock to fracture it. And when that rock fractures, two things happen. One, oil is brought to the surface, and two, a byproduct of that oil is natural gas. Now, when natural gas is $2 or cheaper, most companies are burning that natural gas as it reaches the surface and just taking the oil from it. But what this does is it allows it, since things are changing in the natural gas market, there's actually going to be opportunity for them to profit from that natural gas output. But what that means, John, and it's a really great point, you don't have to drill nearly as many holes in the ground to actually get outputs that significantly increase our oil production on a year-over-year basis. Now, there have been a million different studies talking about the safety of fracking, whether that be, does it infect the groundwater? Is there long-term effects in it? But there's really never been a definite study that shows there's a significant amount of long-term damage or effects that could happen over a longer period of time. And I'd argue that over time, those 15 years, the technology has gotten even better and being more precise and pinpointed of what they're putting into the ground pressure-wise in order to increase the yield from those wells that have already been drilled. But the technology changes there has been astronomical. I mean, even on the offshore space, I mean, it's 10 years has meant light years in regards to the improvements in regards to safety and the amount you can get out just from one drill site as opposed to many drills you used to have back in the day.
Is he going to open ANWR up in Alaska? Is he going to open that again and keep that train going? Because that's going to open a lot of jobs up in the northern part of the.
The only issue with ANWR up in Alaska is the price of oil and the profitability of it. If oil is still in the $60 range, which is the WTI strip, if you look about 6 months out, it's not nearly as profitable as if it's $70 or $80 or $90 a barrel. So it's a fine line you need to walk there, because if the profitability isn't there in a significant way to increase margins for an energy company, they're not going to explore those areas, because the upfront exploration and drilling of those wells is where all the expense and all the CapEx needs to be spent. Now, does the government provide incentives for these companies to be able to do that and tax breaks? That remains to be seen, but that's what I think could really drive ANWR to really open that up faster, or higher sustained oil prices, which makes it more profitable for energy companies to explore those areas.
Yeah, President Trump is talking about the fact that he wants to cut energy expenses to the average American by 50% within 12 months. How does he do that with the current structure that you're looking at?
Yep. So a couple different ways. One is in the gasoline space, because that's really where I think a lot of levers can be pulled. And it's not just a matter of releasing the strategic reserves at different times for political standpoints to try to lower gas for shorter periods of time. It's decreasing regulation. Now, what does decreasing regulation really mean? It means that when a refiner is trying to reconfigure their refining capacity, it's less time for them to get more barrels and things refined, because there's less regulatory issues and less restrictions they have to go through to get there. So Ategenos is based right outside of Philadelphia. If you grew up near Philadelphia and you drove by where the Eagles play and the Phillies play, there used to be a huge refinery right there that has been dormant for over 10 years. It was a huge hub for the Northeast itself. Just getting to the point where you can deregulate things and allow reopening of some of those refineries in a safe way, which has been shown to be able to be done, can increase capacity of those refineries. And that has a direct effect on the ability of gasoline prices to get lower in a very short order and stay there for a longer period. The other aspect of it is what I talked about with natural gas. If natural gas drillers are more willing to drill and increase there, that directly affects significant amount of homeowners when it comes to the natural gas, which is the heating of their homes. So it's not just the oil price and direct aspect from there, but it's all the different other places. The other thing that could directly affect the consumer is every company out there that tends to make goods has to ship them somewhere. So if the energy cost that they need to spend to ship things from one place to the other is reduced, it could usually flow down to lower prices, or at least less increases in prices for consumers over the long term. So there's a multifaceted way that President-elect Trump could affect those ways of decreasing energy prices. And it's not just at the pump, but also when it comes to your home and all those other important things.
Yeah, if you look at the geopolitical issues with shipping liquid gas over to the EU, that's got to make Putin not very happy, because that's going to affect his long-term profits on what he's doing working through EU now. Is that what they're seeing as well?
Absolutely. And let's not forget that there's a Ukrainian war and a negotiation that will likely need to happen that President-elect Trump has promised he would explore. So that's another chip that could come into play from the standpoint of potentially having negotiations to end some of those wars, or at least decreased hostilities in a way where natural gas isn't able to be held over the Eurozone due to those conflicts. So I think that's where things could get really, really interesting in regards to a diplomacy standpoint, even in the first 6 months of his presidency.
Well, that's fascinating stuff. It really is.
Mitch, to shift gears a little bit, what do you see in the renewable energy space in light of the election and the whole drill baby drill kind of moniker? And I know that President-elect Trump's not as much in favor of certain pieces of legislation like the Inflation Reduction Act, which was very heavily focused in renewable energy. Give a little bit of your insight, if you can, on where that might stand.
Yeah, absolutely. I think that the first thing that, if you notice, just talk about a stock market reaction. The day after the election, most solar stocks and wind associated power stocks were down 15 to 20% in short order. What that tells you is that the reality of a Donald Trump presidency is he's not going to support continued subsidies and continued expenses in those areas for those energy sources. Now, why is that important? Because there is still a drastically increasing demand for electricity in the country. And the whole reason we talk about nuclear power is the emergence of artificial intelligence. So the idea that wind and solar power were going to be able to make up that gap, or at least help with a sustainable power source, was a little bit misfounded, because those power sources have been shown not to be consistent enough to really take the load for all the natural gas and other fossil fuel plants that have been shuttered and will be shuttered over the next 5 to 10 years. There's even articles out there as recent as a couple of days ago, and you guys, being where you are, know about the potential for the offshore wind farms that were promised or being explored. And the question being asked is Trump going to scuttlebutt those immediately because he's not going to support, and those kind of projects just aren't economically feasible without government support to be completed. So what I think that forces, the energy market to do is look for the next source of electricity and energy and where it may come from. And that's really where the conversation about nuclear power really comes from, and why I think it's gotten even more interesting than it has been, even though this technology they talk about is close to 15 to 20 years old in regards to the overall concept of what they're building.
Yeah, that's interesting. I mean, nuclear, it's always in conversation from the perspective of a renewable energy, but I feel like it's often overlooked by, let's say, the pro-renewable energy groups that are out there. Is usually they're more focused on solar and wind. But well, maybe take a step back. Without getting the details, how does the technology typically work, and where do you see it fit in light of the need for increased electricity due to AI and those sorts of things?
Yep. So I think you need to take a really clear delineation between, the nuclear power of the heyday. We're talking 3 Mile Island. We're talking Susquehanna. We're talking all those large plants where you see those huge power stacks and the huge puffs of steam, versus what the new technology and what people are excited about, which is the small modular reactors. So a large plant like 3 Mile Island and those things take 10 to 20 years to actually build. Their output is massive, but so is their price tag, upwards of $30 to $40 billion to build. And also, there has been a significant amount of nuclear accidents associated with those kind of reactors. Like you can talk about 3 Mile Island, you can talk about Chernobyl, you can talk about Fukushima in Japan. That's really why a lot of the focus went away from nuclear power for some time. And I'm not here to dismiss that the horror of those incidents and the fact that they can affect local communities as well. But I think what the nuclear, the development area, particularly in the U.S., and really, honestly, a lot of this technology has been, pushed forward by China and Russia, is the idea of doing small modular reactors. So, because there's a couple different benefits. One, it's significantly less expensive. If you're looking at a 300 megawatt kilowatt provider reactor, you're looking at about a $900 million price tag. It takes about 1/10 of the land to house a reactor of that nature. It takes 5 to 10 years to actually construct one. And the safety systems involved with it are passive. Now, the reason I bring that up, and this is getting a little in the weeds, but I think it's important to discuss, most of the tragedies that we've seen from nuclear power, when investigations were done, it was shown that it was human error and operator error that caused these. For instance, at 3 Mile Island, there had to be someone, the safety system was basically someone making the decision to shut down the reactor and contain the incident. Well, they were being fed the wrong kind of information about what malfunction was happening. So guess what? They didn't close it down in time, and there was a meltdown and a release of radiation. Small modular reactors are all based on passive security systems, meaning there isn't an operator or a human that makes the decision. It's a closed system that if there is an actual meltdown, the circulation of coolant inside of it actually cools the reactor on its own. So the chances of an actual incident where there is a release of radioactivity is very, very small. So at the end of the day, what's happening is all the companies that are out there that are pushing AI and saying, hey, let's all own NVIDIA and all these great stocks that are at the forefront of technology, are starting to realize, wow, in order to power this, we need a humongous amount of electricity. that the current grid as it's set up in the U.S. just simply cannot sustain.
Mitch, we don't have an option, do we? If we want to drive AI, and they're talking about even mining Bitcoin. I know President Trump talked about that in one of his conversations. But that also takes a lot of energy. And if you believe in that trend, obviously we're sitting at $90 a coin today. It's kind of fascinating. 90,000 a coin today.
Yep.
It's kind of fascinating. So do you kind of look at that as being a common sense kind of a strategy? We have to develop it, or we're going to be left behind.
Absolutely. And I think that's why you finally see, I mean, you name them, the big tech companies are finally spending money or offering to spend money, because that's always been the biggest impediment, right? You can't leave it to Constellation Energy or a utility company to say, I'm going to spend $1 billion on trying to develop a technology that may be profitable 10 years from now. So you've got Google, you've got Microsoft, you've got all in Amazon. They're all out there saying, okay, we're going to contribute $500 to $700, $900 million to help the proliferation of these things. Now, where it's going to get interesting, and this is where I put a caveat on how fast this can happen. Last week, the Federal Energy Regulatory Commission actually denied Amazon's request in order to have their joint venture add power directly to their data center. And the reason they did that is because no deal has ever been struck like that before. Because at the end of the day, the worry from the entire, the commission themselves is, well, if you do that, it puts the rest of the grid susceptible to liability of failure. Meaning, if you're directing all the power to one place and not making it available to the total grid as well, it creates problems of bottlenecks where the only thing we're powering is artificial intelligence, and I can't turn my lights on at home. So I think there still needs to be a lot done in regards to regulatory aspects of things. Now, there is
but the barn door is open. The barn door is open. I mean, that's the starting point. You have to have that kind of a starting point. Then they can figure it out and make it level across the board.
And the vote was 2-1 in regards to it. And two of the regulatory commissioners decided to sit out that vote, so it was very close. But I think what that starts is the fact that it's still going to happen. It's just not going to be something. It's likely not going to be something that's really producing power and profitable, probably to the end of this decade. But that just goes to show you the amount of investment that needs to be made now, because artificial intelligence is still very much a concept. Right? Everyone's buying software and buying chips, but it's not changing the way we do things on a very daily basis beyond me using ChatGPT trying to write an essay for my, 8-year-old daughter at home. So there's still time in regards to increase that kind of capacity to get it there. But I think what's happening, which is really interesting, is eyes are opening, and tech companies and the for-profit corporate world is finally starting to chip in or admit their willingness to chip in to get that technology to the next level.
Yeah, Mitch, the other energy source it's always that bad conversation is coal. I know that coal burning plants here are very clean, but China's opened up coal plants every week. Why are they not leaning towards nuclear, or are they? And coal is just because they need more energy to just develop a strategy. And how clean are those plants globally? I know that here they're clean, but globally I'm not sure.
Yep. So China is doing a lot of work in the nuclear space. Now, one thing that I'll give China kudos on is China is working on a small modular reactor that actually uses salt as the coolant and not water. Now, that is something that's the holy grail, because you get to that point, then it's a whole different and even less of an environmental impact. But it's still in the very early test phases, and it's something that the U.S. hasn't even explored yet. We're still in the water coolant stage of it. But China is opening plants there because it is the cheapest way and the quickest way to deal with power demand issues they've been having for some time. The infrastructure inside of China is significantly older than the U.S. And given all the issues that they've had in regards to their economy, their aging population, and honestly, debt levels from real estate to everything else, the quickest way. Yeah. So that it's really been, they don't have the wherewithal to spend the amount of money needed for the length of time needed to get that new nuclear technology to be opening nuclear plants there in a much more, expeditious manner.
Wow.
Mitch, you mentioned these modular reactors. Where are these going to be located? I can see, people saying almost like a NIMBY problem, right? I don't want these next door to where I'm living. So how easily are these things put down and usable?
Yep. So I think the biggest difference in the way they're constructed, it really comes to the components. Unlike a traditional nuclear facility that everything has to be done on, you're talking about 500 acres, you're talking about site, all kinds of remediation needs to happen before and after a site usefulness. it's really the idea that most of the components are built at an actual factory and shipped already ready to be assembled once they reach that facility. And when you talk about, size, you're talking about 10% of the land usage of a large traditional facility. And they can be you're always going to have the NIMBY principle anytime it comes to any power generation anywhere. But what we've seen is that what the new small modular reactors are able to do is most of them are built and they're housed underground. Now, the reason they're housed underground and why that's so important is because one of the biggest risks to nuclear reactors is earthquakes. It's natural disasters, which was really the focus of what happened in Fukushima in Japan. So the idea would be that most of these reactors are stored underground, which makes them much easier to contain. And the containment facility for them is also constructed underground. But it can be within a couple miles of the actual usage point. And their footprint is actually much smaller than most people realize. So it doesn't have that eyesore aspect of, Limerick, which we're pretty close to it here just outside of Philadelphia, or a 3 Mile Island from that standpoint. So there will always be environmental concerns when it comes to nuclear power, given, past mistakes of former technologies and the fact that the byproduct is radioactive material. But it is one of the few energies out there outside of solar and wind that is a zero carbon emissions energy option. So I think as that continues to get safer and safer, a lot of the naysayers and the people with that NIMBY principle are going to have to realize that reality being is there really isn't other solutions there if you still want to have the power to power all the things you need and all the new applications from artificial intelligence that everyone seems to be dying for.
Hey, Mitch, now obviously you're a portfolio manager. So when you look at this shift now going on and you look at a portfolio design, are you as an investment specialist buying less green and buying more newer energy like more gas powered plants? Or how are you looking at the markets? Is there a strategy you have over the next year or so as an investor? They might want to adopt some of those philosophies you might have.
Yeah, so at Ategenos, we believe in building well-diversified portfolios, but then we overlay themes into the portfolio. And themes for us are ways to say over the next 12 to 24 months, what are some areas of the market and areas of interest where we can buy, low-cost exposure that benefits or exploits those themes. Back in June, we added uranium as an exposure in many of our clients' portfolios. Now, the interesting thing about uranium, which, for those listening who don't know, is the fuel that powers all nuclear plants. There's really only 2 large miners of uranium in the entire world, Kazakhstan and then a Canadian company called Cameco. Outside of that, there's very few actual miners that make it. And here's the even more difficult part about uranium. Russia is responsible for 50% of the enrichment of uranium in the worldwide. So, although there is not a shortage of uranium now, as we get closer to the small modular reactors which would utilize this uranium being more popular and more prevalent, there is likely going to be a shortage of uranium in the long term. So what we decided to do was take some commodity exposure there. Now, what we've also done is started to invest in some companies startup wise that you can get. You don't need to be cute with these things and say, hey, I'm going to pick the one company that's going to be that one that everyone partners with. There's ETFs out there you can buy that give you global exposure to these companies, but startups that are the ones that are at the forefront of small modular reactors. Because what's going to happen is you're going to have an Amazon that's going to partner with these guys, basically take their capital and bring it to market. And those are the ones that are going to have astronomical growth. So those are areas where we've added exposure to the portfolios just based upon that proliferation of that new energy paradigm. Doesn't mean you ignore the energy players that are out there and the traditional players as well, because let's not forget, it's in the best interest of the big oil companies out there to also be at the forefront of all kinds of different energies. So don't be surprised if you see Exxon and several other very large oil companies start to get very involved in the nuclear space. Because for them, yes, oil is their bastion and will always be their largest profit center. But as the paradigm shifts, so will too the big oil players, to make sure, because they're the ones with the large balance sheets and the capital and the wherewithal to be able to do these long range projects to get to real profitability.
Do you see oil taking a back seat? Let's go over the next 20 years as these smaller modular reactors take hold. Do you think oil is going to be a less of a commodity as a focus, or you think we're still going to always need oil for a long period of time because of our growth in our country?
Yeah, I think it's almost like it's a catch-22, right? We could say, hey, we don't need oil and we're going all towards EVs and electric vehicles, but that puts even more and more of a strain on our electric grid. So I think there's always going to be a place for fossil fuels. I think it will just become less of a dominant player over time. And it's not just going to be because we're worried about the carbon emission and climate change and all those important things. It's going to be because there's going to be other ways to produce power that are absolutely necessary.
And cleaner, basically.
Exactly.
Yeah, I was going to ask you, Mitch, in terms of how some of these technologies work going forward internationally with some of the more developing countries that are going to have more of a demand for electricity as well. How do you see this playing into that? Do these modular reactors get brought to places like India or some other countries in Southeast Asia, or are they more on the oil and natural gas side?
Yep, I think they're more on the oil and natural gas side for now, mainly because they don't have the wherewithal on the balance sheets to basically, fund the amount of research and development necessary to get themselves to the forefront. So what's going to happen is the larger, more developed, wealthier countries are likely going to develop these things first. Then they're going to start to export the technology in some way, shape, or form. So I feel like a country like India, although they can explore things, they're not going to be able to be at the forefront of the technology like a developed country like the US and some places in Europe. So I think there's opportunity there for them, but it's just going to take that much longer, just given the fact of their economies aren't nearly as strong and producing enough revenue to really have that kind of R&D spent over a 10 to 20 year period.
So basically, what I'm understanding what you're sharing with us today, Mitch, is that you think America over the long term is going to be energy independent. It's going to be a major force globally. So we're going to take back what we had maybe 50, 60 years ago as a global kind of a guaranteed house that you could invest your money, you could be part of. You think that's going to be that track?
Yes, we do. And I mean, I think a lot of that goes into our asset allocation, right? I mean, we made changes recently in our portfolios to actually reduce our international exposure due to the fact that we think that, U.S. is going to be the dominant force. Doesn't mean you still don't want to have exposure from a diversification standpoint. But you can see what just in the actions of since the election, the move of the U.S. dollar and the way things that are kind of unraveling, you kind of see the U.S. is going to be at the forefront of there. So a significant bias to U.S. stocks and exposure in people's portfolios it makes the most sense to us as a prudent investor.
And gold and silver, what are your thoughts about gold and silver?
So gold and silver, I mean, gold has detached from its fundamentals a long time ago. It tends to trade very well when people think that the sky is falling, the world is ending. It also tends to fare well when people are worried about the U.S. dollar losing its overall dominance as the world currency. I don't think that risk is really in play. So, although gold has had a fantastic run, and like I said, owning small parts, in your portfolio for defensive purposes is always wise in small portions. I don't see it continuing the run it has, just because there's so much growth in the economy out there, and even earnings from, when you look at the U.S. companies look like they're in double digits predictions for next year, just based upon our growth estimate. So I think that makes gold suffer in the near term, although it's always a good portion of your portfolio as that safety net and bastion of value when things really hit the fan, for lack of a better way to put it.
So you don't see a recession on the horizon?
No. Our investment committee met. We say we've reduced our expectations in regards to recession. I think the only parts of the economy that we're seriously looking at that could still be under pressure is likely the housing market, primarily because interest rates haven't come down far enough that hit that magic number. I mean, most research I've read said that most consumers aren't going to be in the market buying houses until you get to that 5.5 mortgage, and we're nowhere near that, despite the Fed already lowering rates. So being that is a big part of our economy, that's one part that we're concerned about, but the rest of it seems to have some pretty significant profitability that could continue into 2025, which makes us pretty optimistic on portfolios going forward.
Yeah.
That's awesome.
Hey, Mitch, this is great today. We have to kind of run here, but thanks so much for your willingness to come on, and exciting stuff. I think we're on a breakthrough here that's going to really help investors kind of rethink their portfolios going forward with the growth we're having. Hopefully the world will go along with it. Michael, any thoughts?
No, just thank you again for your expertise and for joining us here, and can't wait to have you on again. Be great.
Absolutely, guys. I appreciate the opportunity and look forward to chatting with you guys soon again.
Say hello to the troops for us.
I will, absolutely.
Thanks, Mitch.
So, guys, do you want to tell us how people can get in touch with you?
Sure, Mike.
Yeah, well, Mitch, why don't you tell our audience if anybody's interested in reaching out to you, how they can do that.
Yep. So it's www.ategenoscapital.com. Now, I'll stop you for a second because everyone's going to say, how do you say that? And what does that mean? Ategenos is the Gaelic word for rebirth. So it is ATEGENOS capital.com. You can get insights from us and learn a little bit more about our investment process.
Awesome.
Great. Hey, Michael, how about Copper Beech?
Oh, yeah. Geez. Yes. Well, yeah.
I have to.
We are hosting this
podcast. I have to shake them up a little bit.
Yeah. Well, you can reach out to us on LinkedIn. We're on LinkedIn and other social media platforms. You can reach Copper Beech or myself or my father as well. You can reach us on our website, www.cbfgllc.com.
And listen to our podcast. We have a bunch of good stuff out there over the last few years.
Yeah.
All right.
Right, Wendy?
Sounds good. Sounds good, guys. All right. Thank you to everyone. And thank you for listening today. Please like, follow, and share this podcast with your friends. Until next time, I'm Wendy McConnell.
Thank you for listening to the Truth About Wealth podcast. Click the subscribe button below to be notified when new episodes become available.
This material is for informational purposes only. Neither Osaic Wealth, Inc. nor its representatives provide tax, legal, or accounting advice. Please consult your own tax, legal, or accounting professional before making any decisions. Copper Beech is not affiliated with Osaic Wealth Incorporated. Securities and investment advisory services offered through Osaic Wealth Incorporated, member FINRA SIPC. Additional advisory services offered through Copper Beech Financial Group. Osaic Wealth is separately owned, and other entities and/or marketing names, products, or services referenced here are independent of Osaic Wealth. These opinions are subject to change at any time without notice. Any comments or postings are provided for informational purposes only and do not constitute an offer or a recommendation to buy or sell securities or other financial instruments. Readers should conduct their own review and exercise judgment prior to investing. Investments are not guaranteed, involve risk, and may result in a loss of principal. Past performance does not guarantee future results. Investments are not suitable for all types of investors. Any opinion expressed in this forum is not the opinions of Osaic Wealth Incorporated and have not been reviewed by the firm for completeness or accuracy. Osaic Wealth Incorporated and Copper Beech Financial Group are not affiliated with any other named business entities mentioned.